Thank you so much for being with us. So tomorrow is our big Fed day. Markets seem to be patient and waiting. What do you make of the action we're seeing in the markets ahead of the Fed?
Well, we have already learned a lot from the market this past couple of days with negative GDP. A lot of companies have been missing their targets. We can see at some companies that have been down by 6%, some even down as 12%. Speculators think inflation is going to be sticking around for a while, and well, as consumers, we have to expect to pay more. It's just the thing. If you look at the chart, prices are going to continue to raise. This is nothing new. And what it really comes down to is how are you preparing to put yourself in a situation as an investor to capitalize on the market when it's going down. So I like to look at it as risk adjusted returns. So if instead of shorting the market, I'm just going to go ahead and take out some profits, let my winners run, cut my losses short, and wait for the market to bounce back, or wait for a signal that the market is going to be rebounding soon, because on these rebounds, that's where we have a lot of potential for upside.
Right, and that's the whole thing because inflation certainly is going to crimp growth overall. I mean, at some point, maybe it hasn't. I mean, I know we saw GDP and that was negative, and some of that was attributed to inventories and trade and things like that. You know, you need to see a couple of prints to start to believe it. That being said, there's no doubt that people are paying more at the pump, paying more when they go to the store, paying more for services and traveling and things like that. At some point, many of the guests have been saying, look, inflation will cut into people's spending and ultimately that hits the economy. Is that what you're concerned about?
Well, I wouldn't be concerned about it because we take risks, right? We always take risks. That's the game of the market, right? As investors, you're not just going to go ahead and invest in a stock because you're just going to think you're going to get your profits and just walk away. You assume risk. It's the moment you place your trade, you are assuming risk. That is the reason we get paid, because we take the risk. If I see metaverse kicking off and virtual reality being this big thing in the future, I'm going to place big bets on it, but I also want to get paid for taking a risk, right? This is nothing new. The market is going to continue to be volatile. The Fed is always going to have some sort of impact on the market. Just look back at March. Before the quarterly earnings came out, we were already seeing a downfall in the market. I see it as a matter of taking the punches and rolling on. Take your punches and roll on. Stay in the game. Keep your guard up. I mean, analyze your stocks and look at the data that's in front of you. Like, is it a risk that you're willing to take? If not, then just move on. You don't want to be knocked out of the game right away just because you want to jump on a stock because everyone is talking about it. You want to hedge yourself against downturns like this, and I can tell you right now, the next couple of weeks we're going to be seeing some really rough red is on the chart, some really rough negatives. We're going to be looking at some companies, especially in the technology sector, taking a big hit. But I'll still be a big fan of the metaverse and everything to do with Alphabet company.
So I want to pick your brain on that because Meta right now, I see it at $213. Where do you think that one's going? And hold on. And right now we're seeing Alphabet Google at 23.52. Where do you think that's going?
Well, I mean, with the market, this is one of those things that the technology sector is always going to be the most volatile in uncertain markets, right? We could just look at the past charts. Like whenever the market takes like a 12% turn, and we look at the technology sector, the technology sector is taking these big hits. Well, the thing about both of these companies, Meta and Alphabet, they run their cash flow exponentially well. If you look at Meta, they're just ramping up their cash flow and they're expanding quickly. But if you look at just the recent quarterly earnings that came out and the reports that they pushed out to their investors, that they're going to be slowing down the rate of their growth down so they could focus on their bottom line, and then in turn they'll go ahead and continue with ramp ups in the future. And then Metaverse hasn't been as transparent as Alphabet has, but we can expect it to put some very strong quarterly earnings in the upcoming year. And everyone that doesn't know that Metaverse is part of Facebook, I highly suggest you to look into it, because when you invest in Metaverse, you're basically investing in Facebook itself. And I don't like to just focus on virtual reality itself, although that is one of my one of my favorite industries to be in. When we look at other technology-driven platforms like Etsy, where you're able to have a business online, sell your products online, I believe we are looking at the next big player. And I like to invest in stocks such as Etsy whenever they're this small, because there's an extreme potential for upside and a great opportunity to lock in on some profits for jumping in at whenever it's such a small company.